Inventory should be valued at cost or net realizable value. Cost is what was paid for the goods or the historic cost. The accounting principle of prudence is being followed when this is done, as IAS 2 requires inventory to be valued at the lower of cost and net realizable value. So what is net realizable value? Net realizable value is equal to selling price less expenses as outlined in the box below that are to be incurred to get the goods into a saleable condition. These expenses could include completion of goods if they are being manufactured and selling and distribution costs. Important notes. If you increase the value of closing inventory, you will increase profit. If you decrease the value of closing inventory, you will decrease profit. If you increase the value of opening inventory, you will decrease profit. And if you decrease the value of opening inventory, you will increase profit. These points are especially important when you are attempting multiple choice questions on valuation of inventory. This example is taken from my book, Revising AS Accounting, a Study Guide. Information about this book and other books is available in the last 2 slides of this presentation. A warehouse full of goods was flooded, and this resulted in damage to these goods, which had cost $5,000. These goods can now be sold for $2,000 after they are repaired and cleaned at a cost of $200. How should these goods be valued as closing inventory? Solution. The net realizable value is equal to selling price minus expenses incurred to get the goods in a saleable condition, which is equal to $2,000 minus $200 to give us $1,800. Answer. As the net realizable value of $1,800 is less than the cost of $5,000, the goods will be valued at the lower of the two, and that is at $1,800. Valuation of groups of similar items of inventory. Each item in the group should be considered separately when deciding whether they should be valued at cost or net realizable value. This is to ensure that there are no hidden losses. Let us look at the following. Mali sells 5 different grades of products. The following are the costs and the net realizable value of these grades. Pause the video to study the information given. Let us now look at the value to be used for valuation of this inventory. Grade 1 will be valued at $350, which is the NRV and is less than the cost price. Grade 2 will be valued at $980, which is also the NRV, or the net realizable value, and is less than the cost of $1,000. Grade 3 will be valued at $600, which is the cost and is less than the net realizable value of $640. Grade 4 will also be valued at cost of $570, which is less than the net realizable value of $600. Grade 5 will be valued at cost of $1,500, which is less than the net realizable value of $2,000. Therefore, the total value of the closing inventory would be $4,000. Valuation of closing inventory of manufactured goods. If it is the policy of the manufacturer to add factory profit to the cost of production, then the closing inventory will be overvalued. It is therefore necessary to deduct this factory profit in order to arrive at a correct valuation of closing inventory. This is in accordance to the realization and matching principles or concepts. As no sale has taken place, profit was not realized and therefore should not be included. Valuation of homogeneous inventory. The principle of consistency should be followed here, and either one of the following methods should be used. First in, first out, or FIFO, where the assumption is made that inventory is sold or used in the same order in which it is received. The second method is average cost or weighted average cost, also known as AVCO, which involves the calculation of the weighted average cost of inventory on hand after every delivery. Note, when the purchase prices are rising over a period under review, FIFO will reveal a higher profit. Let us look at the advantages and disadvantages of using FIFO. The advantages first. 1. It is comparatively simple to use. 2. As materials are normally used in the FIFO order and goods sold in that order as well, it is a realistic method. 3. It will be found that closing inventory is valued at current price levels. 4. FIFO is acceptable as a method of stock valuation for the purpose of the Companies Act 1985 and International Accounting Standards, that is IAS 2. 5. Prices used in valuing inventory are the ones that have actually been paid for materials and inventory. So what are the disadvantages? 1. Closing inventory will be priced at the latest high levels in times of rising prices. This results in increasing gross profit, which goes against the accounting principle of prudence. 2. To arrive at realistic selling prices, manufacturers may prefer to use AVCO rather than FIFO. They might, however, use FIFO for their financial accounts to value inventory. 3. Quotations for jobs when raw materials are valued on the basis of FIFO may be unreliable, as job X may be charged for raw materials at a different price from job Y, for instance, though the jobs are similar. Let us now look at the advantages and disadvantages of using AVCO. The advantages are: 1. AVCO is acceptable by the Companies Act of 1985 as well as IAS 2 as a basis of valuing inventory. 2. Prices used to value closing inventory are fairly close to the current prices. 3. This method smooths variations in production costs, and comparisons between different periods become more reliable. 4. Homogeneous inventory have almost identical values, though purchased at different times. 5. The costing of different jobs using the same raw materials is now more reliable and equal. Let us now look at the disadvantages. 1. It is not as simple to use as FIFO, as it entails a recalculation of the average prices every time a purchase is made. 2. The average price arrived at may not represent any price actually paid for inventory. This exhibit is taken from my book, Revising AS Accounting, a Study Guide. At 31st December 20x5, inventory of a certain raw material consisted of 50 kgs, which had cost 40 cents per kg. The receipts and issues of this raw material in January were as follows. Pause the video and study the information given. Solution using FIFO. The following format is the one that I normally use, as it is very straightforward and visually appealing. The first row consists of dates of purchases. In this case, it is January the 1st, January the 4th, January the 12th, and January the 20th. The second row consists of the prices paid, in this case per kg. 40 cents for goods purchased on the 1st, 60 cents for goods purchased on the 4th, 80 cents for goods purchased on the 12th, and $1 for goods purchased on the 20th. This is the price per kg. In the third row, we have the opening inventory of 50 kgs. In the fourth row, we've got receipts. On the 4th, 70 kgs were bought. On the 12th, 100 kgs were bought. And on the 20th, 50 kgs were bought. Let us now look at the calculations. On the 6th of January, 60 kgs were issued. Therefore, using FIFO, 50 kgs would come out of opening inventory, and the remaining 10 kgs would come out of the inventory bought on the 4th, to leave us with 60 kgs at the rate of 60 cents to give us a valuation of $36 for closing inventory. On the 16th, 80 kgs were issued. 60 kgs will come out of inventory purchased on the 4th, and 20 kgs will come out of inventory purchased on the 12th, to give us a remaining inventory of 80 kgs, which was purchased on the 12th at the rate of 80 cents, and therefore closing inventory on that date will be valued at $64, which is 80 times 0.80. On the 26th, 70 kgs was issued, all of which will come out of goods purchased on the 12th, to give us a remaining of 10 kgs. Therefore, on the last day of January, the 31st of Jan, the closing inventory was 10 kgs from goods purchased on the 12th and 50 kgs from goods purchased on the 28th. When we value these, we will get $8, which is 80 cents times 10, for goods purchased on the 12th, and $50, which is 50 times $1, for goods purchased on the 20th. Therefore, the total valuation of closing inventory at the end of the month, 31st Jan, was $58. Let us now calculate AFCO using the same information. The solution. On the 1st of January, the balance brought forward was 50 kgs at the price of 40 cents, Therefore, the average price or cost was 40 cents to give us a value of $20 inventory on the 1st of Jan. On the 4th of Jan, 70 kgs were purchased at a price of 60 cents per kg, and that would be $42. Let us now look at working 1. The average cost is therefore equal to $20 plus $42, which is the total value of inventory held on the 4th of Jan, divided by 120 kgs, which is the number of kgs of inventory held on the 4th of Jan, to give us an average cost of 52 cents. On the 6th of Jan, 60 kgs were issued at the cost of 52 cents according to working 2. This works out to $31.20. On the 12th, 100 kgs were purchased at a price of 80 cents per kg, and therefore the new average cost would work out to $110.80 divided by 160 kgs to give us 69 cents per kg. On the 16th, 80 kgs were issued at an average cost of 69 cents, which would give us $55.20. Therefore, the value of closing inventory on the 16th of Jan would be $55.60. On the 20th, 50 kgs were bought at $1 per kg. That works out to a valuation of $105.60 of 130 kgs. The AVCO, or the average cost, would therefore work out to 105.60 divided by 130 to give us 81 cents. On the 26th, 70 kgs were issued at 81 cents. This works out to $56.70. Therefore, the closing inventory at the end of the month was $48.90, which, when rounded off, will give us $49. We will now take a closer look at the difference between perpetual and periodic inventory. A perpetual inventory is a record of a running balance of stock or inventory on hand after each transaction. FIFO and AVCO are examples of perpetual inventory. A periodic inventory, on the other hand, shows the value of stock or inventory on hand only at the end of a period of, say, a month. The total issues are deducted from the total receipts to arrive at the balance of items in stock. We will use the same example that we used in the previous 2 slides. The quick method below of calculating closing inventory using FIFO is an example of a periodic inventory. Solution. The quick method of calculating closing inventory using FIFO and the figures in the exhibit alongside. Units received: 50 kgs, 70 kgs, 100 kgs, and 50 kgs to give us a total of 270 kgs purchased. Units issued: 60 kgs, 80 kgs, and 70 kgs to give us a total of 210 kgs issued. Therefore, the balance of kgs or units in stock are 60 kgs. Let us now calculate the valuation. Out of the 60 kgs, 50 kgs will be valued at the latest price of $1 to give us $50. The remaining 10 units will be valued at the price of 80 cents at which they were bought to give us $8. Therefore, the value of closing inventory will be 50 plus 8 to give us $58. Tip: use the quick method when solving multiple choice questions on inventory. This is a question adapted from a past paper. Juan owns a business selling electrical goods. He was unable to count his inventory at his year-end of 31st March 2016. He counted his entire inventory on the 6th of April 2016 and valued it at a cost of $57,760. Pause the video to study the information given carefully. You are to prepare a statement to show Juan the value of inventory to be included in the financial statements at 31st March 2016. Here is a method of converting markup to margin. The markup was 25% or 1/4 in fraction form. The margin is therefore calculated as 1 plus 4, which is the numerator plus the denominator, divided by 4, which is the denominator, to give us 5/4. The cost will therefore be 5/4 inverted, that is 4/5 times the selling price. Solution: Juan's statement to show the value of closing inventory. Inventory at 6th April 2016 was $57,760. Purchases at cost price was $6,100. Sales at selling price was $9,600 times 4/5 will give us a cost price of $7,680. Sale or return at selling price $2,100 times 4/5 will give us a cost price of $1,680. Customer returns $650 at selling price times 4/5 to give us $520 at cost price, which will be deducted. Therefore, the inventory at 31st March 2016 at cost price was $60,500. Remember, as per the prudence principle and RAS 2, inventory is to be valued at cost, and therefore, in this case, inventory that will be included in the financial statements of Juan's at 31st March 2016 will be $60,500. More information about AS Accounting, a study guide. This book is available at most book outlets worldwide, including Book Depository and Amazon. They are available in hard copy as well as in e-book format. The content of this book matches the latest CRE AS syllabus and is pitched at a level that is extremely workable. The book is written by a qualified and experienced teacher and fills the need for a guide that is solely meant for the CRE AS accounting course. Some salient features of the book are: it unpacks the CIE AS accounting syllabus. IAS terminology has been used. Students love the unique question and answer presentation of theory. There are numerous tips for success and exhaustive exercises for practice. Here are other titles available: AS Accounting Workbook, a write-in workbook that will help you prepare for your examinations, and Revising A-Level Accounting. Please contact me at junebaptista@hotmail.com for more information and for answers.